Welcome to QB's first virtual firm update and market outlook. My name is Vanessa McNabb, and I'm joined by QB's President and CEO, Joe Jugovic, and Ian Cooke, Vice President and Portfolio Manager. We usually like to meet with you in person, but unfortunately we're not able to do so. So instead we're having a socially distanced video to hopefully provide some insights on common client topics that we discuss over the past little while. So Joe, QB's culture is something that we talk about quite often in our client meetings. It's of utmost importance to us, and it underpins everything that we do at QB, from our investing to how we run the firm. Can you comment on some of the steps that QB has taken to further enhance that foundation, despite having one of our executive members leave for retirement last year, Wendy Booker-Urban?
Sure, Vanessa. Culture is important in all organizations, but particularly in an investment management firm where really your assets are your people. Continually investing in your people in the organization is extremely important. We want our people to feel proud to work here, as we feel that they'll give the best service to our clients if they do. And in that respect, over the last 12, 18, 24 months, we've been bolstering our staff. So we've been adding to the operations group, we've been adding to the investment group, and to the client service group. And that's something that we've made a commitment to years ago to our clients, that QB would continue to grow and make sure that the next generation, as the firm evolves, is stronger than the previous one. So we've seen that in those areas. In addition, and something that we've always done that's a little bit unique, I think, to the industry is we offer our employees share ownership, and that's really been growing as well over the last couple of years. So we've probably got just around 90% today of our employees that are owners of the firm. And there's a WestJet credo that used to say, owners care. And we truly believe that. We believe when an employee takes ownership in the firm, they have more than just a job at stake. They really take it personally, and they want to do the best job they can. So those have been big elements from on the people side. And again, on the ownership, we expect at the end of this year that will continue to broaden and grow over time. Technology has been another area of focus. When we talk about culture, you can't have a strong firm and fall behind on technology. So our clients likely would have seen a new website, a new refreshed website, but more than just the look, the effectiveness or the usefulness of it through the client portal. And we've had excellent feedback from our clients on how we've tried to evolve with that. And they'll see more from us. The next project we're working on there, and there always seems to be a project, is trying to get rid of some of the paperwork and the signing off on documentation, which is part of the regulatory environment. We have to do it, but we're trying to make it smoother, easier for clients to deal with. And then lastly, in the last couple of years, as far as what we can do from a culture or evolving for clients, we're looking at software on the financial planning side that we can try to bring into our practice over the next year, as well as potentially increasing one more product within the investment line. So all areas of the business are being considered and trying to grow.
Mm-hmm. That's excellent. Well, change is always apparent, and we have to adapt, and we've had to do that recently with the global pandemic. Can you comment on QV's ability to manage through this environment while also maintaining high levels of collaboration despite an ever-changing environment?
Sure. We, in Calgary, our clients may remember, I think it was probably 10 years ago now, that we had a flood. Mm-hmm. And that flood actually, oddly enough, prepared us for a pandemic, which is something you wouldn't connect. Mm-hmm. But after the flood, there really became that focus on your business disaster recovery, on your continuity plan. And our operations group has done a wonderful job over the last 3 to 5 years ensuring our technology infrastructure is in place. So when the pandemic hit us, not that it's something we're planning for, we were able to move to a work from home environment immediately. But it was a very awkward environment in that you had stock markets around the world collapsing while we're working from home. And we had trading happening, we had investment committee meetings happening, we had our client service meetings still happening. And I'm really proud of the team and how they pulled together and were able to get through something that if it would have happened 5 years ago, it might have been more of a challenge. But really, that's how we moved forward. Toward the summer, we started slowly bringing our people in, always from day one, with the thought that it's people's health and safety and their families that have to be number one. And we'll slowly get ourselves back into the office. And we're finding that again, we're having more meetings in the right formats. But we're getting there. So it's something that I think people feel good about. Everyone knows how they've pulled together to make sure that that was able to happen. Oddly, from the pandemic, in January, when we talk about how do we work during the pandemic, in January at our investment committees, we were talking about how we would go forward when there was another large market correction. We didn't know it would be a pandemic that would bring it about, but that discussion in January. So when they talk about being prepared for an event, you need to be thinking about it beforehand. You don't buy hurricane insurance in the midst of the hurricane. That meeting and that discussion that we had really put us in a mindset where, oh my, we're getting this correction. And we were able, I think, to take good advantage of buying, much better businesses on sale during a very stressed time in the marketplace.
That's great. And here we are today sitting together, properly social distanced from each other and doing a video for the first time. So that speaks to that ever-changing environment and adapting. So maybe if we look back a little bit more on history and with your long time at the firm, can you comment on this notion that we've discussed with our clients at length that our style of investing has been out of favor for some time? You've been through multiple cycles with QV. Can you comment or reminisce on any other periods that you feel are similar to this period, or would you say that this period is much more extreme? And what does that imply for our clients?
Sure, it's a great question. It's probably one we can spend a lot of time talking on because it sets up a lot of the context about what's happening within the market versus what's happening within economies. And there's often differences. I'm sure many clients will be sitting at home going, wow, markets are approaching their old highs, breaking through, and we're in the midst of a pandemic. And so often the stock market and the economy operates differently. The stock market is typically 6 to 9 months ahead of the economy. And so there are differences. But if we go back to that question of value and growth, one thing as investors, when you look at the last 100 years, you recognize that markets operate in cycles, just as the seasons do. We go from spring to summer to fall through winter. Stock markets have all kinds of cycles. There's presidential election cycles. There are value versus growth. There's small cap versus large cap. Well, the value growth one has been the predominant driver of where returns have been generated in the last decade. And it's been the most exaggerated period that we've seen now in 90 years worth of data. So what we mean by that is the types of businesses that QV is trying to invest in. So we're trying to invest in sustainable businesses run by capable, candid management teams and buy them at a good valuation so we can actually deliver a return to clients. Those types of businesses are not of prime interest to the investment community. In the last 10 years, it's been the growth companies, the companies of the future, which have really garnered all of the attention. So what you've seen in this last decade has been the biggest divergence or outperformance of those types of businesses relative to the types of businesses we invest in. And while that is frustrating when we find good value, we know we've got a sustainable business, management's doing all the right things, but the market won't give them the credibility. We do recognize that those cycles will change. And I'll give you that example that we've used. The most recent time we've seen this type of extreme was the late 90s. And there's a lot of differences between the late 90s compared to today. Back then, you had a lot of, the internet came to the scene, a lot of technology companies, but they were just starting. They didn't develop franchises and go on to, dominate areas of the market. That has been happening now. But there is one really considerable similarity, and that is the investor attention. And back then, what you saw is money come out of stable businesses, chase a lot of the growth, a lot of the technology businesses, and they dominated the market for a number of years until they didn't. And that's when you had the change in the cycle. And we believe we're in that type of environment where, Ian, in our last quarterly update, talked about the difference between TELUS and Tesla. And it's such a good example of a good, stable business that you will use as a Canadian consumer. If it's not TELUS, it's Rogers or it's BCE. You're not going to get away from it. Yet investors just don't seem to care. And they're willing to pay out 10, 15, 20 years of a prediction on the future growth of businesses. Our belief is that it will change. And when it does, you're going to see that a lot of the businesses we've invested in, there really is significant underlying value. So while it can be frustrating while it's occurring, and that's exactly what happened to us in the late 90s, for a number of years, it was very frustrating. And you can't keep up to the benchmarks. If you do, you have to change what you do. You have to try to follow and chase performance. For us, it's more important to stick with our discipline. We know that over time it will work. And we believe that that is coming closer. That extreme is only been amplified through the pandemic. And once that changes, we really think you're going to see that benefit within our portfolios.
Adding to uncertainty during this time is also this geopolitical environment we find ourselves in. And as you can imagine, it's the topic of conversation with a lot of client meetings, lively conversation, and particularly as it relates to what's going on south of the border, but also on our home turf here in Canada. So Ian, can you comment on some of these themes and what that might mean for the positioning of our client portfolios?
Sure, Vanessa. It's a timely question. And Canada has certainly been out of favor for international investors for some time. Part of it's cyclical. I mean, we've been going through resource malaise, in particular in the oil and gas sector, for several years now. And a lot of it is also related to, what's been working in the marketplace. And a lot of investors tend to gravitate towards those areas that have been working in an outsized way in more recent times. And the U.S., after not performing that well relative to a lot of countries in the first decade of this century, has really come back. It's come out of the ashes, and we've seen outsized returns there. So for the last decade, the U.S. has returned, in Canadian dollar terms, over 16% per annum, where the Toronto Stock Exchange is compounded at less than 6% per annum. So a very large divergence there, which has caused a lot of people to say, you know what, let's forget about Canada or other parts of the developed world, and let's move or stay focused in the U.S. That's been a bit of a headwind, but when we look at the fundamentals of Canada and we step away from what the stock market has done, this is a place where very high quality, high standard of living, tremendous economic freedoms, a population that continues to grow. We continue to be the envy of a lot of not just the emerging world, but the developed world, where we're attracting more immigrants than we ever have. And the population continues to grow in terms of education. And, over the last 20 years, year in and year out, we've consistently seen more individuals graduate from Canadian universities than ever before. And that number has nearly doubled over that period. So a country with, strong underpinnings, a growing population, a growing educated base is a wonderful backdrop for long-term investors. But saying that, our investors and investors in general can benefit from global diversity. And we weren't able to offer that at QV 15 years ago. We did develop a global equity fund, and that's been in place for over a decade now. And that has allowed investors with QV to get more exposure to some of those great businesses that are beyond the Canadian borders. And our investors should expect from us, as we continue to grow in our capability there, to offer that capability to be able to invest broadly where the quality business representing attractive value, regardless of geography, as long as it's a stable economic jurisdiction, that we see being a very strong benefit for our investor base over time. Speaking of politics, the geopolitics side, it's never easy to predict. I mean, the polls don't get it right consistently. We've all seen that. And, regardless of who is leading and how they are leading. What's really important to us is that we know that markets and companies have gone through all types of different environments. From a leadership perspective, markets have gone through wars, impeachments, tough environments. What's important is that we're focused on our investment philosophy. Are we investing in businesses that are enduring in nature, that can navigate through those difficult periods or geopolitical tilts that go away from where we've traditionally been accustomed to? And are they governed and managed by managers that have the capability to navigate through those difficult periods? And that's what we expect from our businesses. And I think our investors and investors in QV should expect from us, an ability to navigate, an ability to endure, and demonstrate that capability through all sorts of different environments.
So it sounds like adversity always presents opportunities, and there's no lack of opportunity. And that was the case that Joe alluded to earlier during the downturn. Can you speak to some of the changes or actions that QV took when opportunity was presenting itself recently, and maybe comment on some of the themes of what has been working and not working or slower to materialize?
Sure. That reminds me of a saying, flowers grow through dirt. And I think there's some parallels when thinking of our investing. And over the years, some of our strongest periods from a long-term investing perspective have come out of difficulties like the recession after the collapse in technology stocks 20 years ago, the financial crisis a little over a decade ago, and now as we're going through this pandemic. And we don't think it's a coincidence. I mean, it's very difficult to deploy our clients' capital at attractive rates of return when everything is rosy and everybody wants to invest. Because then the return environment typically gets skinnier and skinnier. But it's when there's rampant fear or there's dislocation in the marketplace, that's usually when the long-term opportunity to own a quality business is most rewarding. And we do monitor and measure these risks month in and month out. And I think that's allowed QV to identify and better capitalize on these opportunities when they do develop in the market, not get tied up in the emotions that are top of mind for everybody when we're going through a difficult period. So in the spring, through our risk management, certainly didn't identify what the future looks like, but what it does identify is what's priced in from a valuation perspective in terms of how much uncertainty is priced in, and it identifies, are the businesses that we're investing in positioned from a balance sheet perspective, which is also important because you may be right that we're going to get through this, but if you don't have the balance sheet to endure for a period of time, then you're going to be in some trouble. So we did, similar to the financial crisis, we did see fairly consistent reduction in cash levels in our equity mandates, taking advantage primarily in opportunities within our existing portfolios, recognizing that that valuation advantage was more attractive than it had been in over a decade. We also identified opportunities that we had in our inventory, so companies where we admired them, but only from afar during the good times because they had a number of qualities that represent our investment philosophy, but we couldn't make the valuation side of the equation work. So when markets were dislocated, being able to invest in a company like CCL Industries and our Canadian large cap fund, which has a wonderful record of compounding value over the long term, presented itself in the global fund. There was a lot of disarray, and when the lockdowns first came about, and that provided an opportunity to invest in the world's largest recreational vehicle manufacturer. And we found as the summer went on, more and more people were still traveling. They were just doing it by land, and we're seeing kind of record demand for that kind of product these days through Thor Industries. Another company that we added in the small cap arena is the royalty franchise for A&W, the quick serve restaurant company based in Canada that's demonstrated a very strong record over the years, but had to shut down a lot of stores at the start of the pandemic. And that kind of disruption allows for the opportunity to buy a business like that at a very attractive price. So try to take advantage and eventually allow those flowers to bloom as the world, although we don't know what the new normal looks like, normalizes somewhat. Mm-hmm. In terms of what's been working most in the marketplace these days, in the recent kind of post or pandemic world that we've been in, we've seen a record amount of monetary stimulus. And those companies that have benefited most from that, gold companies, companies with high expectations for growth, and investors are willing to pay more for that expectation because interest rates are so low than they ever have before. Those have certainly been working best in the market. We've had some rebound from a lot of areas of the market, but we are sticking to our knitting, making sure that we've constructed a portfolio of businesses trading at attractive value relative to what's out there in the market. Companies that are building value, not just in the immediate term in relation to what's going on with the pandemic today, but through an economic cycle, through a business cycle, and making sure that they have the tools and are set up with the capabilities and the management teams to navigate and grow their franchises well into the future.
Leading into the downturn, we were discussing with our clients the merits of a more conservative asset mix, and that was very helpful in weathering the downturn, in protecting against losses. Now, during the crux of the downturn, we did decide to increase equities for our balanced clients. Can you discuss why we chose to do that then and why that's important for our clients over the long term, despite the lingering uncertainties that remain?
I think Joe touched on it in relation to some of the preparation and the scenarios that we talk about in our various investment committee meetings and asset class committees. And you couple that with a risk-managed approach to investing and our commitment to our monthly risk audits, in combination with what we're witnessing on the front lines, where the equity teams are using cash to deploy in opportunities as they're developing in the spring. And then in combination, seeing bond yields go lower and lower and lower, and the income streams being generated from bonds being less and less compelling. Those are all drivers. And so we did move our asset mix in equities towards the higher end of our typical range from an investment policy perspective. We do recognize that can add more volatility. Equities are typically more volatile than bonds, but we are generating more income from dividend yield relative to bond yield than we've ever seen in our history here at QV. So we do think over the medium term, our expectation generating more income from equities than we've historically garnered relative to the income generation from bonds, and the opportunity for capital appreciation for the medium and long-term investors remains beneficial. Now, why own bonds is a good question in this environment with yields as low as they are. And because of the stability that they provide, and they are certainly a buffer and insurance policy if a second wave of COVID creates further economic deterioration, that certainly provides support and more stable income, reducing that overall volatility of the portfolio.
Thank you. Well, we're almost out of time. So if you could highlight some of the key takeaways for our viewers and clients at home, what would they be?
Some of the key takeaways. I think, first off, investing in the last 20 to 25 years has been pretty tough. We had the 2000 meltdown, we had the 2008, 2009 meltdown, and now the 2020. So it's almost, every 10 years, there has been a really sharp, volatile bear market. And unfortunately, we don't think the volatility is going to disappear. I mean, look at the environment we're in right now. We've got an election that we don't know what the result's going to be, and we don't know when it's going to actually be announced. We have pandemic that continues. We have government spending amounts of debt that they haven't since World War II. So we have a very uncertain backdrop. But what you must remember is, I love Ian's comment about, flowers grow through the dirt. And investing is that. Investing is finding opportunities to invest in good, sustainable businesses when all the pieces of your puzzle don't quite fit. Because as soon as you can see how all the pieces of the puzzle fit, that means every other investor can see the same thing. So your opportunities are often in those uncertain times, and we are certainly in those. And our clients have to understand that, as much as we would like to invest back in what might have been the early 90s, when stock markets were making double-digit returns in many, many areas, that's not the environment we find ourselves going forward here. And it's going to be a lower return environment. When bonds are yielding 1% or less, we're going to have to depend more on that equity. So that's going to add some volatility, but we feel that we are getting paid for it. I will mention takeaways. One thing I often look at is, what are the people making the decisions doing? So when I look at our equity teams, and if I hear them speak positively toward their portfolio, but if they've got 10% of cash, there's a disconnect. I look at our equity portfolios today, I hear the teams talk about the opportunities, and I see that they have very low cash. On top of that, as a firm, we have more invested through our employees and retired employees in our funds today than we've ever had in our near 25-year history. So there is a real commitment by our team to what it is we're doing alongside of our clients. And that's really important because, Vanessa, one thing we always talk about in looking at a company is we want to find management teams that are committed and invested in that business. It's not a job, it's much bigger. It's an investment. Their financial wherewithal depends on it. We're all in that same boat. So if we struggle, our clients are struggling, but we are as well. And it's really important that we're not going to take excessive risks. We're going to try to be conservative and move forward in the right way. And, our clients should pat themselves on the back a little bit because this was one of these very jarring environments, and we did not have one client completely get out of the stock market. That is a big deal. And that sets you back at least a decade when you do that. So we're thankful to our clients, working with our team, with yourself and Katie and Jason, and being able to withstand some of this volatility. And that's a really important part of being an investor and keeping that long-term, what is my goal? My goal is not trying to maximize 6 months, 9 months, 12 months. My goal is over time trying to protect capital and to grow at a reasonable risk level. So that's how I would try to sum this up. Ian?
I would just add, throughout all of this, there's a lot of things that we can continue to learn from, but we remain committed to our investment philosophy of investing in those quality businesses run by strong teams and committed to quality, committed to value. And we remain committed to excellence in investing and in client service. So it's a very exciting time for us here at QV. Joe talked about the investments we've made in personnel and technology, and it's just a wonderful place to take part in that growth and look forward to the years ahead.
Thank you. Thank you both. And thank you to our viewers at home. We're grateful for your continued confidence in QV. We look forward to being able to meet with you again in person one day. And until then, in health and happiness, we wish you all our very best.